Okay. Hello, everyone. My name is Lucian. Most of you know me from Twitter as Triangle Investor. My guest today is David Cates. David is the CEO of uranium development company Denison Mines. David, welcome to my show.
Hey, Lucian, I'm very happy to be here, and I've been following you myself on Twitter for some time, and look forward to having a great discussion.
Thank you very much. Dave, can you give my audience a short introduction of your business path in uranium, and how did you become Denison Mines CEO?
Well, Lucian, that's a bit of a long story, but yeah, I've been with Denison now, going on 14, 15 years. And my background is in finance, so I'm trained as a CPA in Canada. I have a master's in accounting from the University of Waterloo, and I don't normally advertise that because I don't find myself to be a conventional accountant. But that is my path, as I started working for one of the global accounting firms, PwC, in Toronto, and all of my experience from the very beginning was on mining clients. Toronto is a major mining center, and so I began right out of university working on clients like Barrick Gold and Inco, which of course then became Vale, and I became a specialist really, and my experience then took me to a gold producer called Kinross, which had assets in a variety of continents around the world. Yeah. And from there, I joined Denison on the finance team. And at the time, it was 2008. The company, was transitioning through the financial crises. Yeah. At a time that was still actually quite robust for the uranium market. And I was with that team for a few years as a director level on the finance team. And then we endured the Fukushima situation, which was very negative, of course, for the industry and the company. And the company started to reshape itself. It went from being a U.S. Producer. We owned Denison at the time owned the White Mesa Mill and a number of conventional U.S. uranium mining assets. And seeing that we might be in for a bit of a long downturn in the uranium market, we decided to sell those assets and position ourselves more focused on high-grade development and exploration assets in the Athabasca Basin. And that created opportunities. So our management team had a few changes and some retirements. And that created an opportunity for me to become the company's chief financial officer. And so I worked together with Ron Hochstein, who was our then CEO, for a couple of years. And Ron progressed from leading our company to run a company called Lundin Gold, which is a hugely successful story of developing the first mine in Ecuador with a very profitable and very successful gold mine there. Ron is still our board chair, and when he moved over to run Lundin Gold, I was promoted to become the CEO of the company. And from then we carried out on this strategy of divesting our international assets and focusing on building a really sustainable, low-cost uranium producer through pursuit of our exploration and development assets in northern Saskatchewan. And so fast forward several years, and here we are today, and we've just put out a very exciting feasibility study for our Phoenix project, and we truly are on the path to becoming one of the lowest cost uranium producers in the world at what I think will be the exact right time for the uranium market. So I've snuck in a little bit of Denison into my personal history, but they are so closely related because I've been here so long.
Yeah. Let's talk company projects. You mentioned Wheeler River. That is, of course, your flagship projects. And for the audience who are not familiar with Wheeler River, the Wheeler River consists of Phoenix deposit and the Griffin deposit. And Wheeler is one of the largest undeveloped uranium mining projects in Athabasca, and one of the most high grade in the world, I would dare to say. David, please give my audience a short overview of this project, and then you can tell us what are you doing at the moment at this project, and what are the plans for the upcoming period?
Well, look, Wheeler River has come a long way under Denison operatorship. We've discovered those two both high-grade uranium deposits as operator. Importantly, they're in different geologic settings. Yeah. And so that's, I think, we're usually I go to give the background is just that Phoenix is hosted in sandstone, and it has some very high grades. We're averaging in the double digits when it comes to grades across the deposit, but most importantly, the large majority of the resource is contained within what we call the Zone A high grade core. And in this area, you have grades that average 46%. So this is exceptionally high grade. And that's the nature of these sandstone hosted Athabasca Basin uranium deposits. Now, because of the fact that it's situated in sandstone, we have been advancing Phoenix as the first in situ recovery uranium mine in Canada. And maybe we come back to that, to just provide the comparison for Griffin. So Griffin is located about 3 kilometers away from Phoenix on the same property, but it's situated in basement rocks. So it's not amenable to ISR mining. We need the permeability of the sandstone rock. So Griffin is designed as an underground mine. Its grade profile is more in the 2% range rather than up in the double digits, but 2% is still a very high grade uranium deposit against global standards. And of course, again, that's the nature of these deposits in the Athabasca Basin. So we've designed Griffin as an underground mine that would benefit from a number of existing infrastructure supports in the Eastern Athabasca Basin. Just to call out some of those, I mean, we're located just west of the Hall Road and the power line that already connects McArthur River to the Key Lake Mill, that are Cameco operated projects. And we have our own 22.5% ownership in the McClean Lake Mill, not too far away. Yeah. And so Griffin benefits from the fact that we already have a mill that has excess license capacity or an ownership interest in that mill. And the Phoenix project is coming first. And so Phoenix will bring a lot of the infrastructure to site, like connecting into that power grid, a camp, all of the basic utilities will be on site for Phoenix, and the Griffin deposit will benefit from that. So we're looking at these as, and in our latest feasibility study and technical report update, we're looking at these as two separate projects that are complementary. So there's not a reliance on either one. They could be built separately, but you can see that our company has been focused on Phoenix. And so where we're going is developing Phoenix aggressively. We're looking to proceed straight into detailed design and engineering, following a front-end engineering design process that is already commenced before we put out the results from the feasibility study. And Phoenix, is really the beneficiary now of the work we did all the way back in 2018, which identified that it could be amenable to ISR mining and could have potentially some of the lowest costs in the world. That gave us the latitude to invest over the last 5 years in the project. And I know we're thinking about what's next, but one has to recognize that, the uranium market is far better today than it was 5 years ago. Definitely. But what you can't do is make time out of thin air. And so the fact that Phoenix was a good project, viable, when the uranium price was $29, is what helped us spend the money, raise the money, spend the money, and advance the project over those tough years to be in a place where we are now today, well into the permitting process, with a feasibility study complete, about to pivot into detailed design. I mean, that is a huge competitive advantage against most of the projects in our industry. And it could only happen because of what we've done over the last 5 years. That's what's put us in position to be there today, to say we're on the track to developing an asset and becoming a producer in the second half of this decade. It's a lot. It's honestly, it's quite a long and slow process developing these uranium mines. So the fact that we've done that work over the last 5 years is actually quite important.
Yeah, good point. One of the things that my subscribers always ask me, when is Denison going to produce uranium? Do you have a timeline?
Yeah, well, with our announcement at the end of June on the results of the feasibility study for Phoenix, we have provided updated guidance on our production timeline.
Yeah.
And so what we're guiding right now is that we're expecting to be about 2 years away from completing the permitting process. And then we have about a 2-year construction timeline for the project. And so that would put us into the 2027/2028 period for first production from Phoenix. And I know that for many that might seem far away, but it's actually in sort of nuclear years or uranium years, it's very close. We are already several years into the permitting process, which is very robust in Canada. And, you can't do studies and delineation drilling and all these things. You can't do these things overnight. So we're actually getting quite close to producing. And I've sort of started to compare this project in our timeline to even some of the restart projects that are out there. I mean, many people talk about projects that are production ready or things like this. Well, I mean, at some point, I suppose that will be true, but how many years until, a project that could be restarted is restarted? Even the restarts take time. And I think our timeline is starting to converge with many of those restart projects, just based on how aggressive we've been to continue to advance without waiting for a higher uranium price.
Yeah, and the second question I always get from my subscribers is going to ISR work on Phoenix? Are you closer to a point where you can say it will work?
Well, yes, we've passed that point now. I think that question maybe a year ago was still open. We'd done a lot of test work in the lab and a lot of work in the field. But
but I mean that you are 100% that it will work.
Well, yes. I mean, we've recovered uranium from the ore body using ISR mining techniques already. And that test that we completed through the third and fourth quarter of 2022 was critical. I mean,
definitely.
We've literally taken the work from the lab and the work from our field, combined it in what we called the feasibility field test, where we injected an acidic mining solution right into Phoenix, and we recovered uranium. We had acidification very quick, and we're able to start recovering uranium to the point where we recovered over 14,000 pounds in solution in only 10 days. So I think we've proven that the mining method does work. It has been de-risked to the maximum extent possible without building and operating a mine. And I would say our feasibility study supports that, because importantly, our feasibility study is authored by a third party. Our Canadian securities regulations, they don't allow us to issue our own technical report. So this study has been validated and approved and authored by Wood, which is an internationally recognized engineering firm. And so they have the applicable qualified people that have certified that the work that we've done supports these conclusions. So particularly with that field test, we would say we have crossed that threshold, and actually ISR mining does work at Phoenix.
Great, David. That's the thing that my subscribers want to hear. Let's talk a little bit about the numbers on Wheeler River. Can you remind my viewers what is the capex for that project, and some other numbers, important numbers like all sustaining costs and IRR and similar metrics?
Yeah, so great questions, and of course we're happy to talk about these things because they're excellent
Yes, they are.
We'll sort of look at the two projects separately, but note that Phoenix comes first, and so the initial capex at Phoenix has been estimated now, and this is also important in current day dollars, because we've just done this study, so we've reflected inflation and the cost environment. We're looking at initial capital costs around $420 million Canadian.
Yeah.
Now, Phoenix does generate immense cash flow. And so we do expect that the cash flow from Phoenix would then fund the initial capital costs for Griffin, which are estimated higher because it's an underground mine rather than an in situ mine.
Yeah, other method.
Griffin has capex in the range of around $740 million Canadian. Now, that's still quite low compared to other conventional underground mines in the region, because we're using the infrastructure for Phoenix and because we're making use of the McClean mill, which of course already exists, is already licensed, has excess capacity. So yeah, it's much higher than Phoenix, but it's much lower than comparable underground mining operations would be. Definitely. Now, if we go back to Phoenix, Phoenix is really unique because we're taking the world's lowest cost uranium mining method, in situ recovery, and we're combining it with one of the world's highest grade undeveloped uranium deposits. And so our economics have been really strong by putting those two things together. We have a base case after tax IRR, or internal rate of return, of 90% on this project, which is very strong. Yeah. We're looking at base case post-tax NPV relative to initial capex, like as a ratio of 3.7 times, which is a very strong number. And then when you look at the costs, you sort of understand why. We have operating costs estimated around $6.30 US per pound. And then what we call all-in costs. And this is not all-in sustaining, it's like all-in full. So it's initial capital, sustaining capital, operating, and closure over the life of the mine, sort of divided by number of pounds produced. We're coming in at US $16 per pound.
That's unbelievable. Yeah.
It's excellent. It really competes with the best assets in the world, which are primarily ISR in Kazakhstan.
Yeah, definitely. Those are Kazakhstan ISR numbers, I agree. Okay, wait, you have another great project, that is Waterbury. You have a PEA on this project, also with great economics. Can you give us an update on this project, and what are the plans for, what are the next steps?
Yeah, so Waterbury certainly is an interesting project. It's smaller scale than Phoenix, but it is also ISR. Yeah. It's exciting because it's quite close to the McClean Lake mill. So we're able to sort of offset some of the scale, the fact that it's smaller scale, with the fact that it's closer to a processing facility that we have an interest in. So this project, let me just pull up some numbers here. Yeah. We're looking at a capex that's just over $100 million. And of course, that's from 2020 and our PEA. So obviously subject to update. But because of the nature of the mining being ISR, we do have very aggressive and competitive operating costs projected on this, around $12 US, again from 2020. And then when you load in that capex, because there's only about 10 million pounds that we're recovering here, you've got around a $25 all-in cost. Now, I kind of equate this project to the best of the US small-scale ISR. Similar production rate, 1 to 2 million pounds a year. Cost profile much lower because of those grades that we're dealing with. And the capex, comparable to what you'd see from some of those US ISR projects. Encore, for example, is just acquired or is acquiring Alta Mesa, and that's a good project for Encore. But their purchase price on that project is more than our capex for this project, and this project will generate, an NPV that we're estimating pre-tax on a 100% basis, around 265 million. So it's a really interesting project, and it proves up that you don't need 50 million pounds for ISR to work in the basin. Yeah. You need the right kind of geologic setting. You need the right host rock. You need proximity to infrastructure, and something in the range of 10 million pounds could be economic. Now, what we've done with this project is we did that study in 2020, bit of a proof of concept of how big does a project need to be for ISR to work. Yeah. Then we mostly parked it because we focused our de-risking efforts at Phoenix, and we said, look, we're not going to do too much more at Waterbury and our THT deposit until we've proven Phoenix up all the way through the field test and the feasibility study. And now that we've done that, you do see that we have, pretty healthy budget allocated for THT Waterbury this year. And we are planning to carry out some more field work. And so that work is along sort of following our program that we've used to de-risk Phoenix, to collect more information around THT so that we can hopefully be in a position to update our economics with something that's more robust and more current, in the coming year or years. So, we're turning back to Waterbury THT now that we've completed that Phoenix de-risking and it's been successful.
Okay. David, what about McClean Lake mill and deposits over there? Can you give us an update on the status of the mill, and what are the plans, your plans and your partner's plan of course, because you are it's not owned only by Denison. So can you expand a little bit on that, please?
Yeah, no, for sure. And McClean is a cornerstone asset for us. So we are 22.5% owner. Orano, which is the French nuclear giant, they own the balance of this, and we're together as joint venture partners. So the mill is I don't use the word world class very often. I find it's sort of overused.
State of the art.
Yeah, but the thing is, the McClean mill truly is world class. I mean, it's the largest uranium processing facility, or one of the largest uranium processing facilities in the world, and it's been uniquely designed to process these high-grade ores from the Athabasca Basin without dilution. And that's a difference to like the Key Lake mill, for example. McClean was designed with the grades in mind, enormous amounts of concrete and shielding to manage the radiation associated with processing some of this material, super high grade. But it is a special facility. I joke around, but I'm serious when I tell people that, we can show receipts for about $1 billion of spending on this facility historically. It's licensed today by our federal regulators to process up to 24 million pounds a year in U3O8. The mill is operating today under a toll milling agreement with the Cigar Lake joint venture, and they have rights up to 18 million pounds a year in production. So today we have 6 million pounds a year in excess licensed capacity at the mill. We also recently received approval, I guess now it's not as recent, but within the last year and a half, received approval for the tailings facility to be expanded from our regulators. And so that adds longevity to the facility without major capital projects to, for example, create a new tailings area. So this really is a unique asset, and our objective, together with Orano, is to generate the maximum return we can from this asset. And our view generally is that we would like to process, joint venture owned ore through the mill. Now, of course, we have unmined deposits at McClean Lake, which are an obvious target for the mill. And we have been evaluating ways to mine those economically. Many of the deposits have already been mined out via open pit in past years. The remaining deposits, they're obviously smaller and or slightly more challenging than those other deposits. And so we have been evaluating a mining method that the McClean joint venture owns, the technology called Sabre.
Yeah.
Sabre is a way of excavating a small pod of uranium from surface using a borehole and a high pressure water jet nozzle that cuts the ore in the ground and then basically floats the cuttings back up the drill string for processing on surface. So that mining method has been tested over years of R&D by the McClean joint venture, and it works. So we're certainly looking at whether that can be used to extract the remaining deposits at McClean, but also we're looking at whether we can provide other sources of feed to McClean. So, for example, Denison has been evaluating Griffin for toll milling McClean. And more recently, and this is actually quite exciting for us, we've been studying the use of in situ recovery mining at the nearby Midwest deposit. So we also co-own Midwest with Orano.
That was my next question. Please expand a little bit on Midwest.
Yeah, no, it's a very exciting project. You know, Midwest has become, it's quite an old project, in that it was discovered many years ago. It's been advanced as a open pit mine historically, and actually received permissions from the environmental assessment side of things to be developed as an open pit mine, which is really the biggest hurdle to the permitting process.
Yeah.
But it's not a very good open pit. It's under a lake. It has a very bad strip ratio. So the project has not been developed. And what's very exciting is that through our discussions with Orano over the last few years, we've been suggesting that it may be wise to evaluate Midwest for ISR mining. And over the last 2 years, we've had support from Orano, where the Midwest joint venture has actually hired Denison to do the assessments or initial assessments for possible ISR mining. And earlier this year, we announced that we were advancing with a program in 2023 with some site-specific evaluations after completion of a concept study, and that we may be in a position to produce a PEA on the project as an ISR mine, you know, by the end of the year or into next year. So this project has significant resources that are at very good grades, and so it falls sort of between Phoenix and THT. If you put them on the spectrum, it's quite closer to Phoenix than it is THT, but it is also very close to the McClean mill. So it has a lot of things going for it as an ISR project, and I think you can tell we're pretty excited to have a chance to carry out these evaluations.
Yeah, definitely. David, I would like to touch on your other projects as well. You have an impressive number of portfolio of more than 30 projects in your portfolio. And you don't talk often about them. I would like to touch on them. Which of these other non-core assets projects will have some work done this year?
Yeah, Lucien, we're working exploration always on our portfolio. Often there's exploration at Wheeler, looking for new deposits that could be maybe a satellite to Phoenix. But basically, we do a bit of a competition in terms of the merit of our other properties to identify which ones should be funded for exploration. And you're right, we're actually quite quiet about the exploration. We have a lot of things to talk about on the development assets, but we always have a very healthy budget for exploration. And actually, when you compare it to our peers, or maybe the small, you know, exploration-focused companies, we usually have a larger budget than almost all of them when it comes to exploration. So this year, we've got some really, really exciting programs underway. One of which we've already put results out on, which was the property called Moon Lake.
Yeah, I saw it.
Yeah, so this project is just to the south western side of Wheeler River. And we've been exploring this project over the last several years. But earlier this year, we encountered our first real sniffs of high-grade mineralization. And what was exciting about these results is that, again, they were in sandstone and actually perched. So perched means some distance above where that sandstone and basement contact occurs.
Yeah.
And the model here is that we're not normally finding in the Athabasca Basin perched mineralization that is occurring on its own. All the cases that really exist of high-grade perched mineralization can sort of be connected to a larger or more meaningful deposit that is often at that basement unconformity contact. And that's prime for us in terms of ISR amenability. So this is a very exciting project for us. The proximity to Wheeler is excellent for us. And the fact that we have quite a dominant land package around this property is also very exciting. So you can expect us to be following that up. The other project that we're working, again, quietly, is a project called Johnston Lake. And that's up in the, what I would call the northeastern part. It's sort of northwest of Cigar Lake. And so this is a project that we've been cultivating for the last few years, and this is our first time out there drilling. So I would stay tuned for drill results there. And then maybe last piece would be the interests we have in other projects as a minority. So we have put out results on Waterfound River, which is a joint venture with Orano. And through our ownership of JCU, which is a company that owns a variety of minority interests, and we own half of JCU, we're also participating in the Christie Lake property. So quite a lot of exposure to quite a lot of very exciting projects right now in the Athabasca Basin. And you're right, we often don't talk about it because we're focused on our development side of the business.
David, what is the plan for those other projects? Are you looking for some partners on the other projects that are not at your focus at the moment, or is there an option to spin out these projects to another company and that company remains focused on the core assets? What's the plan? Is there a plan?
Yeah, look, that is a good question. We have a very long-term view on the company, and we think we're advancing the company to become a producer and to have other targets to build our company on. And so we're reluctant sometimes to dispose of assets that we think have good potential for discovery or that could form the next asset in our pipeline. But we have done some work where we are looking at taking partners or optioning some of our projects to new partners. And we're generally doing that where things are non-core to us. And so you'll see we announced an agreement, or at least Skyharbour Resources announced an agreement regarding South Dufferin. I mean, this is a good project. We've spent quite a lot of money on South Dufferin over the years. It just isn't core to us because it doesn't fit with our focus on the ISR amenability. And so Skyharbour is a company we have a significant investment in. And we believe that they will do a good job to take that asset forward under their project generator model. And so that's an example of the type of thing we have done. We are a bit reluctant to take our portfolio of assets, which are focused in the east, around where we have our key footprint, and anything that has the potential to become the next ISR deposit. We're reluctant to partner that off or spin it out. Now we know that there is a case to say that could create value for our shareholders right away, and we are trading that off with the prospect of making sure that we have targets to continue to explore ourselves so that we can find the next Phoenix. And so that is the balancing act associated with those types of assets. It is something we monitor closely. And, spinning out assets has to be done at the right time and in the right environment. And we don't want to leave ourselves without the right pipeline for our own core business. So that's the tension around that. But look, we look at our success at Moon South and say, if that becomes, a meaningful satellite deposit to Phoenix, then it's excellent that we've kept it in the company.
Got it. How would you describe your relationship with First Nations in Saskatchewan?
Well, look, I think we're doing really well on that front. It's a challenging environment in Canada right now on the Indigenous engagement side of things. But we have been very proactive on this. And today we still are the only company in our space that has a Indigenous peoples policy that has been approved by our board of directors. And it's not to say that companies are not operating responsibly, but we elevated that policy to our board of directors for a reason. They're the voice of our shareholders, and they give the mandate to management. And so it's a clear sign that we are prioritizing the importance of the way we interact with Indigenous groups. Now, we have taken, again, a long-term view on those relationships. And so we started by reaching a series of exploration agreements with a variety of groups. It's important to understand that the Athabasca Basin is not one part of town. There are multiple parts of town. It's a very large geologic basin, and there are multiple Indigenous groups. And so our approach was to build foundational agreements with the Indigenous groups that have ties to the areas that we operate. And so we've announced multiple exploration agreements, and they cover all of our work in a particular ancestral land or traditional territory of a given group. All of our work before mine construction, essentially. And so that means that we have established bases for engagement and consultation. We have benefits sharing happening even with our exploration and evaluation work, rather than just waiting to sign a big impact benefit type agreement because we have a project. And so that is leading. I mean, we were the first to enter into those agreements. We have seen others follow, and we're pleased with that. You know, it's excellent to see others recognize that that type of engagement is necessary. Now, I call them foundational because the intent is where a project moves forward beyond the exploration and evaluation stage, like Phoenix, that we would graduate to something like an impact benefit type agreement that really works towards getting consent from the indigenous groups that could be impacted by the project, and structuring sort of something more complete or more thorough than sort of the level of agreement we have on the exploration agreement. But the key is that we approach all these relationships with trust as an important currency or part of the relationship. And these exploration agreements at the bottom, that foundation, they've given us the base to establish that trust. And so our process right now, and we have you know, impact benefit type agreements under negotiation right now, but that process is all based on that foundation of trust from those first agreements. So again, long-term view, you know, it's not just about Phoenix for us. We've already set that foundation for all of our projects. And the view that Phoenix is first, and, you know, Griffin or THT or the next discovery or Moon South will be next, and we'll build on that foundation going forward with the indigenous groups. And look, it's been very successful. There's no better way to show it than to talk about the test we carried out at Phoenix last year. I mean, we carried out the first field test or pilot of the in-situ recovery mining method using, you know, a live acidic mining solution in the ore body. We carried that out at Phoenix, and we had the support of the communities that we were consulting with. And that was no doubt critical to us getting regulatory approval to carry out that test. And that support came from the processes that we already had agreed through our exploration agreements and the benefits that were already planned to be shared from that work. So we've already seen that our relationship, the way we've structured it with that foundational support, has been very successful.
Yes, definitely. That is a good sign. The company holds 2.5 million pounds of physical uranium in portfolio, which is worth around 200 million Canadian if we look at today's uranium spot price. Is the plan to use this material for covering future costs for Wheeler River, or do you see a scenario if you see a sharp rise in spot price that you sell a portion of that material or the whole thing? Do you have the plan?
Well, look, there's many options for this material, and you know, it's first of all, it's very unusual for a developer that doesn't have a significant source of production or cash flow to have a balance sheet that at the end of the first quarter, we were estimating, you know, over $225 or $230 million of working capital and investments. So it's very unusual. The physical uranium is an important part of that. And the use of it will really depend. It'll depend on circumstance. It'll depend on the market. It'll depend on alternatives. But you're right to highlight that there are many possible uses. So just to sort of elaborate on some of those, you know, when we raised the money and bought that uranium, we saw it as adding great balance sheet strength without crystallizing sort of a share price from a financing, because we did issue shares at a fixed price, but we bought an asset that was dynamic and an asset that was linked to our industry. And so effectively the proceeds from that financing have floated, and they've increased significantly since the time we did it. But the balance sheet strength was important. We wanted to move forward with Phoenix with confidence, knowing that we could execute on our plans because we had a balance sheet that could fund us one way or another through any further ups and downs in the market. And so what might we do with it? Well, I mean, we could use it as a form of collateral to access credit. and maybe we would access that credit on better terms or access credit that's otherwise not available because it's de-risked in part by having a physical asset that we can use as security. Normally, developers have their unbuilt asset, or their unbuilt mine as the primary form of security. Well, that's slightly a slightly flawed form of security at times, which leads to higher cost credit, because if for example, you're unable to pay your debt, then it's possible that your unbuilt asset or has not been successful, which makes it not the best form of collateral. So I think we have an option that might be better than that with the physical uranium.
Yeah.
We also have the potential to use it in our commercial discussions with utilities or future utility customers. One of the barriers to meaningful long-term contracts is often the risk of production for non-producers or for developers.
Yeah.
So having a stockpile of physical uranium could certainly de-risk maybe the first delivery of for a meaningful contract to a utility. It could also be used as a form of support for or collateral for a prepay if that's coming from a utility, which is another way to raise money. But also it is sellable. You know, our intent is not to, you know, flood the market with physical uranium, but there's certainly market circumstances where if our equity valuations or access to credit are not something that meet our objectives, and the uranium price is strong or has increased, then it might very well be the right thing for us to sell some of the uranium to fund operations or fund part of our construction. The reality is that, you know, our company has costs ahead of us to build a project. And, you know, we have to fill that void one way or another. The physical uranium obviously accounts for a very large portion of that void. And I think that's a key differentiator for us, is that the shareholders can look at us and other investors and realize that with that stockpile there being accessible one way or another, the extent of dilution that might be, you know, subject for us to raise the money to build the project is much lower than typical. Because again, most companies have not got that kind of asset on their balance sheet at this stage in their life cycle.
Yeah, it's maybe important to say that you acquired this material under $30 per pound. So
yes,
good deal, definitely.
Yes. It's worked out very well for us so far.
Yeah. David, what is the current cash position of the company, and how long do you think that amount will get you through?
Yeah, so I'm just pulling up here. We reported at the end of the first quarter cash position around 57.5 million Canadian. So our second quarter financials are coming out the beginning of August, so we'll have an update there. Look, we are spending aggressively to move Phoenix forward. So I think we have a very clear disclosure of our plans for 2023 in our management discussion and analysis. We have a full outlook section on that. So it's very easy for people to refer to our complete plans for the year, all of our projects. But basically, you know, we are with our physical uranium, our investments, and our cash on hand, we're in a very healthy position to avoid having to do any sort of major, you know, equity financing at a major discount to market or with warrants or anything like that. Our preferred method has been to use an at the market or ATM. When we're able to do that, and we're very selective about that. We like the idea of having a strong cash balance and raising money when it makes sense to do it, when we like the valuation. And we do it very quietly and carefully. You know, we disclose quite clearly all the activity we have on the ATM. And if I were to look, say, at 2022, just for example, the total activity on our ATM in terms of shares issued during the course of all of 2022, for much of the year would have equated to 1 day's average trading volume. So I'm quite confident that we're not having a notable market effect by using the ATM. And we are accessing capital at the best prices. Now, another key part of the ATM is the cost on it. We pay the brokers very little. The brokers, of course, don't love that, but it's excellent for our shareholders. And we're always issuing the stock at market. So the sort of discount to market on an overnight deal or any of a half warrant or warrant, the cost of that We just don't have that in our financings. Now, these ATMs work. They don't work for everybody. They work well for us because we have very good trading liquidity. And so we can be selective in it without that market impact and access very low cost equity. So you can expect that we will continue to use something like an ATM to maintain a robust cash balance and avoid any of the sort of splashy equity financings that sometimes can affect, longer term share price performance. To the extent we can avoid that, we're going to try to do that.
Is share consolidation as an option on the table for the company? I mean,
it's something we have in our mind, but it's a bit funny because the share count. It's to me. I mean, I'm an accountant, of course, by background, so I just do the fractions of it all.
Yeah.
It's the denominator, right? So you take the company's value on the numerator and you divide it by the number of shares, and that gives you an approximation of the value per share. Having more shares doesn't in and of itself destroy value. It's what you do with what you got for those shares. And so I could see the utility of a share consolidation, but I'm not a fan of it as a one-off event. I think share consolidations are the kind of things that make sense where you have a transformative transaction or something notable where maybe your share count would go up very dramatically, and so you will sort of repackage things. But all they do is just reduce the size of the denominator and change the math. I don't like doing it on its own. I would prefer to do it as part of something else. And I focus again more on what we've done with the money, and so I generally point people to look at where we've come from, and it depends what share count they want to look at and how many years back. But generally, where we've come from, if you look at the sort of pounds U3O8 in resources or reserves per share, if you look at that, say a decade or 15 months or 15 years ago, and you look at the same today, generally, you'll find we have more pounds per share today. Yeah. They're higher quality, so reserves rather than resources, and they're higher grade, and they're more profitable projects. And so while the share count is up, literally every share today has better assets or more assets, more uranium associated with it today than even when we were in 2007, 2008, or any of those sort of periods. So, I watch the share count, but because, I'm more watching the cost of raising money rather than I'm worried about the absolute number of shares out there.
Okay, you touched on Skyharbour a few moments ago. You have an ownership in Skyharbour and in Goviex also. How is your relationship with those two companies? Are you actively involved? Do you have a board seat on those companies? Are you actively involved in decision?
Yeah, look, we have notable investments. Denison does in both companies, and I do currently sit on the board of directors of both companies, representing Denison's interests. Yeah. I've been a personal investor in both companies as well. As a director, serving for Denison, but also myself, I've been an investor in the companies. Look, I mean, what I like about them is that they are different than Denison. So Skyharbour offers, very good exposure to the Athabasca Basin Discovery Junior Exploration Company. Skyharbour has very good liquidity, and I really like Jordan as a manager. I think he does a very good job of telling the story, and I think it's quite sensible. Like the transactions that Skyharbour has put together through that project generator model, and the amount of money that will be spent on Skyharbour projects is really remarkable. I mean, he has a slide in his slide deck that sort of pulls that all together, and to realize that that company has exposure to all of that spending across their portfolio, plus has its own sort of dual flagship properties that they are controlling in and are operating for discovery. That's really an excellent combination if people are looking for exposure to the Athabasca Basin discovery story. Yeah. I think it's the best in that space. Goviex, that our investment in Goviex came from Denison's former international assets. We started talking a little bit about that at the very beginning.
Yeah.
So we vended our African assets that were in Mali and Zambia into Goviex, and that helped the company build a geographically diversified portfolio of African development assets. Today, Goviex is unique in that they sit with 2 projects that are mine permitted. They are operating with a flagship in Niger and an emerging sort of dual flagship in Zambia with Matanga. So, look, I think Goviex is probably one of the most undervalued companies in the sector. They have an enormous base of resources.
Yeah.
And you know, with the right time and the right market and the right investors and buyers, those projects will be very valuable. So yeah, it's interesting. I like them because they offer totally different exposure to Denison, which is that flagship Athabasca, large scale, you know, developer. You've got an African developer with Goviex, with mine permitted assets, and then you've got a junior Athabasca discovery focused company with Skyharbour. I mean, it's my own that's my own personal uranium portfolio that I'm invested in the space.
Okay, one final question, David. Do you believe that any company besides Denison, of course, will produce uranium in the Athabasca in this decade?
Well, I think it's possible. I think it's possible. You know, I give a lot of credit to the team at NextGen. I think they, you know, have excellent leadership, and they are doing a lot of the right things. They're doing a lot of the same things that we are. So, you know, their project and our projects, we have a lot of things in common, in that the projects have the potential to be very low cost. And whenever you've got that, globally very competitive, there's a good reason to pursue production. And I don't think I would count NextGen out. After that, though, it's hard. And we talked about this a little bit earlier, time. I mean, you can't buy time. And it's really been Denison and NextGen that have spent the time and the money and the resources over the last several years to be as advanced as we are today, to have the chance and the prospect of producing before 2030. I think after us, the list is there isn't anyone else really on the list. And I would include that Cameco doesn't have a new asset that is in the Athabasca Basin that could achieve that timeline either.
Yeah.
So it's, you know, really, if it comes to large scale, meaningful new development assets in the region, you're looking at, in any reasonable time frame, you're looking at Denison and NextGen. Excellent.
David, I want to thank you for being my guest and for answering all my questions. And I wish you luck with Denison as well as your private life.
Well, Lucien, thank you so much for making the time for us and for following us. And we really appreciate all your support.
Thank you very much.